I would like to call the pension board meeting to order. Let me see what our agenda says here. Where are we? Okay. New business. To hear and consider and act upon the election of officers. And I would like to formally open up the nominations, and I would like to nominate Carolyn Trambuco as chairman of the pension board. Are there any seconds for the nomination?
I second it.
Tom McCarthy, I'll second.
Who seconded? Sorry,
Tom McCarthy.
Thank you. Please say your name so I can write it down because I can't see you. Thank you.
Are there any other nominations? Well, hearing none, before I call for a vote, I would just like to say that I've been impressed with Carolyn over the past year, watching her in this role on the pension board, and I think she is highly qualified, balanced, smart, calm, and I think she is exactly the right leadership that we need for this pension board, and I look very much forward to working with you in this coming term.
Thank you.
Is there any other comments? Seeing none, I will close the nominations. All in favor of Carolyn Trambuco as chairman of our pension board, raise your hand or say aye.
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 Aye. Aye.
And so I believe that is unanimous, Chris, for the record.
Thank you.
Thank you, guys. Thank you very much.
Well, thank you. And so now that you are officially the chairman, I believe you need to open up the nomination for vice chair.
All right. Well, thank you. I will gladly do so. I would like to open the nominations for vice chair. This would be for the Joint Investment Board. Are there any nominations would like to come forward?
I would like to make a nomination, Madam Chairwoman, and I would like to nominate Tom McCarthy as vice chair.
Okay. Are there any other nominations? Or anyone else who would like to step forward? Okay. Hearing none, we can move to a vote. All those in favor of nominating of
Carolyn,
Chris?
can we get a second on the nomination first, please?
Oh, I'll second it, Eric Newman.
Eric?
Thank you.
Thank you.
Okay. So then in that case, now that we have a second, if we could move forward with a vote. All in favor of Tom McCarthy, assuming the role of vice chair of the joint board, say aye or raise your hand.
Aye.
Aye.
Aye. Aye.
Aye.
Terrific. I believe that is a unanimous vote for the record. Congratulations, Tom.
Thank you so much. I can't wait to work with Carolyn.
We're going to do it.
Yeah. As with every member of the board. So this comes. I'm very excited about this.
Terrific. All right. Let's move forward. Now the board also has a secretary role. I'd like to make a motion, or if I could hear nominations first for board secretary. Anyone like to step forward? It's not a heavy lift. It's a pretty easy one, guys. Anyone like to step forward and fulfill the role of secretary?
That's easy for you to say. It's an easy one.
Oh, you're the recording secretary, Chris.
The ceremonial secretary.
The ceremonial secretary.
No, I'll do it. Nobody wants to do it.
All right.
I nominate Eric Newman.
I'll second the nomination for Eric Newman. Anyone? Thank you, Eric. Eric. Let's go to the vote. All in favor of Eric Newman for secretary? Raise your hand and say aye, please.
Aye.
Aye.
Aye. Aye.
All right. I believe we are of one mind. We are unanimous on Eric Newman. Congratulations, Eric.
Thank you.
Thanks for joining us. We have, I believe we have to do this for both of the individual boards, right? That was the joint board. I think if I'm not mistaken, one of the old timers can tell me, do we have to do this for the individual boards or just for the joint?
I think
It said go ahead, Chris.
I think they have to do that at their own separate meetings, don't they? Yeah. And
Yes, I believe so. Because
Okay.
in the agenda, it just says Joint Retirement Investment Board. And
Okay. Perfect. All right. So then let's move forward, folks. Here we go. You should have received in your packet from Chris, dated November 25th, the calendar of meetings. If you recall, our meetings happen the third Wednesday of each month. If you would take or maybe fourth Wednesday of each month, if you could take a look at that. I didn't see any conflicts with any holidays. If you recall, we don't have an August meeting, and we combine our November and December meeting into one in early December. So if you look at the calendar, that's scheduled for, December 1st of 2021. Okay. I'd like to ask for a motion to approve the calendar of meetings for the 2021 year.
Eric,
Motion to
I'll
approve.
make a motion to approve the proposed 2021 meeting schedule.
Okay, thank you. Eric Caliber, thank you. A second, please.
Tom McCarthy.
Tom McCarthy, the second. Okay. Well, if we may show of hands, or I'll say aye in favor of approving the calendar for 2021.
Aye. Aye.
Aye.
So sorry,
Aye.
it's Russ. Just a quick point here. April looks like it's the third Wednesday, not the fourth.
I think they're
Just before we vote and approve it all. It should be the 28th instead of the 21st.
I think the same with July.
I didn't get that far yet. I was trying to unmute myself to get in there before I get that far. Yeah, it's also the same in July. Yep.
That's a good catch. Why don't we? Would you like to make a motion to amend the calendar to be the fourth Wednesday? So that would be April 28th and July
28th also.
Okay.
Yep.
Okay. Should we take a vote on the calendar as amended to reflect the fourth Wednesday of each month, that including April 28th and July 28th, with no August meeting, but the November-December meeting is combined into one on Wednesday, December 1st.
Is that
Motion to approve.
date right then, or should that be the 29th?
28.
The September.
September. 29th.
29th.
No, that's the fifth. That's the fifth Wednesday.
Ah, good call. 22nd, correct.
The 22nd is correct.
Right, it starts on the first. You're right. 1, 2, 3, 4.
Yeah. It's just one of those months with 5 weeks in it.
All right. So we'll read off the dates. Wednesday, January 27th, Wednesday, February 24th, Wednesday, March 24th, Wednesday, April 28th, Wednesday, May 26th, Wednesday, June 23rd, Wednesday, July 28th, no August meeting, Wednesday, September 22nd, Wednesday, October 27th, Wednesday, December 1st. Okay. So Chris, guide me on this. Are we able to just vote on those dates? Or do we have to vote on the...
I would say you could vote on the dates as amended.
Okay. Right. All in favor of the votes as amended? Raise your hand or say aye, please.
Aye.
Aye.
Aye. Aye.
Aye.
Okay. We are unanimous. Thank you for catching the dates on the calendar, guys. Okay. Next, moving on to conflicts of interest forms. This is something this board is required to do. We do this on the December meeting each year. You would have received it in that packet from Chris. If you haven't already returned it, Chris, you wouldn't happen to have a list of who's returned it so far, would you?
I do. I have a list of who returned it, and some people are dropping it off to me tomorrow. So all I'm missing right now is Walter Burke, who's going to drop it off. Tom Connolly, I have not received. Chris Brand is going to drop it off. Nick is missing.
I emailed it at 4:30 today.
Oh, that's right. You sent it to me today. Russ Atkins is going to drop it off, and I need Bruce Ryan, and Tom McCarthy is going to mail it to me. So we're pretty good.
Okay. Thanks, you guys.
I
Terrific.
didn't even drop it off.
Even better.
Yep.
All right. Thank you. That's really important for this board that we get them all in. And then the last point under new business on our agenda is onboarding material. We have a page on the town website under the pension board that has drop-down file tabs, and in that tab are forms and important items for the pension board for all members. It includes the investment policy statement. It includes where we fit kind of the legislation that covers the pension board. It has been updated. It was updated this week, and so I would encourage you to peruse that. That's where we keep the materials for the onboarding. I think Jack Mahoney was really instrumental in pulling a lot of this material together. So, Jack, thank you again for making it easy for us.
Certainly.
Yep. We have two brand new members to our board, Kevin Shadeen and Nick Caruso. Welcome aboard. I sent both of you an email with the links to this, so hopefully you've had a chance to peruse it. And, if anyone would like more material or kind of a guiding hand, please reach out, and we will and we'll bring you up to speed as quickly as we can. Okay, so with that, moving on to point 3, to hear, consider, and approve the minutes of October 28th, 2020 regular meeting. This is the one where we invited the Board of Finance to the meeting. Not sure if anyone's had a chance to review them. If so, if somebody would like to make a motion to approve those minutes.
I have a motion.
There's a lot of typos in there. I think that probably needs some. I only got a chance to look at it maybe 20 minutes before we jumped on, but there's a lot of just cleanup, I think, on.
We can do a cleanup. We can do a cleanup. Why don't we put them aside? Eric, do you have any thoughts that you want? Any changes or amendments?
Yeah,
I
I had some cleanups to the comment that was stated to me too. So maybe we can email any revisions to Chris and then maybe take it for a vote next meeting.
Yeah, I think that's a great idea. All right, we'll vote on this in the next meeting. Eric, if you could CC me, you guys are, and Tom, and Eric Newman, the officers, so that way we're involved in any changes to the minutes.
Yeah, if anybody wants to email me with suggested changes, I can edit the document, and then we can all compile it and send it to Chris all at once.
All right, terrific. Then let's move on, guys. The performance review. Brian, thanks for joining us. So you guys, I'm excited about this one because, I'm an equity analyst, and so it's really exciting when we can focus on equities because it's my favorite thing to talk about. Even though we run a very well-balanced and well-constructed portfolio, the equity part to me is always the exciting part. So we're going to talk a little bit about equities, but we'll talk about what was a pretty good performance month too. Brian?
Yes. Hi. Good evening, everyone, and welcome to the new board members. I look forward to working with you and, of course, Carolyn and the new chairs. So how would you like to do this? Does everyone have the presentation, and I can tell everyone what page we're on?
Yeah, I think that's
I could try sharing screens, but...
Why don't you share the screen for those of us who are watching? And if you could just call out the page numbers for those who are dialing in. Chris emailed this presentation around earlier this week. So it should be right in your inbox.
Okay. So I hit the share button, and let me know when you can see that on the screen.
Yep, we got it.
Okay. Well, as far as the agenda, as Carolyn alluded to, the way I've broken out the performance is do a recap of where we are year to date. We'll talk, of course, an update of the plan performance for both the pension and the OPEB through October. And as Carolyn alluded to, we'll talk about, especially for the new board members, the approach that we've taken on the equity side. Maybe we could do a subsequent section on fixed income or a different asset class in future meetings, but today we just focused on the equity. And then we put in some long-term rate of return forecasts. Our assumptions were just updated as of 9/30 data, but this was not to do any votes at this meeting. This is just really to set the basis for 2021. And it kind of summarizes a lot of the topics that we already talked about in 2020. So I'll start there, but I'll always add, please interject as we go along. I don't mind taking questions, of course, as there is. Tell me to speed it up, slow it down, and we'll go right from there. I'm going to be joined later by my colleague, Brian Scott. He had a personal appointment that he had to dial in late. So I'm on page 4. And this is just, I included this chart just to recap us where we were. We all know it's been a crazy year, both health-wise, emotionally, of course, in the markets and economically. But focusing on the markets, as far as it seems so long ago, but as a reminder, at the beginning of the year, we really had the fastest bear market in history as far as how quickly the markets plunged. And it's also been the quickest recovery, and this is the dotted red line, where we're now positive on the year. And this chart looks at 2 other financial crises, 2008 and the dot-com bubble, the most recent ones. And you could see that fall and recovery was much longer on both sides. So extremely volatile year. This is showing how far down the equity markets were at the nadir. So it was down over 30% in less than 3 months. But what a recovery we had since then. And then just looking through, this is the end of the third quarter. So global equities are up over 1.8%. Bonds, which have been really the ballast all year, up over 4.2%. So this was, again, just to see it pictorially, where we were and where we are. And so long-term investors were rewarded, again, just by staying the course. And that's something that we always preach, is focusing on the long term. Page 5, this is just looking at the more granular level. This is just the broad indices. So U.S. stocks have outperformed international stocks. So U.S. stocks are up over 3%. While international stocks have continue to lag, and they're down 7% year to date. As I mentioned, bonds, they've done exceptionally well. Flight to safety in this environment, falling interest rates benefit bonds. So both U.S. bonds and non-U.S. bonds, which are part of the portfolio, are positive. The big thing that's happened in the markets, though, despite that recovery, it's been really bifurcated. And I included this slide 6, just to show some of the discrepancy in the markets. And the biggest one is about value and growth stocks. The good thing here is for the portfolio, is we've taken a total market cap approach, so we own the entire market. But you see growth stocks on a year-to-date basis up over 19%. Think technology, value stocks, energy, financials down 13% year-to-date. You see this is just showing the sectors on page 7, what I just mentioned. This is looking at 1 year, but look how wide that dispersion is, and that's why it's good not to try to time the market and own the whole market. But page 8 is just, I thought, very interesting to show the committee. I talked about the very narrow leadership is what's moved the market higher until only recently in the last month that the market leadership is broadened out. But this is looking at the top 5 stocks as a percentage of the S&P 500. You remember some of the names back in 1999, 2013, and then as of this year, the top 5 stocks kind of at a record level as far as their share of the S&P 500. All familiar names of Apple, Microsoft, Amazon, Google, and Facebook. You own those stocks, this is more for the active management. You did really well. If you didn't, you did pretty poorly. Page 9 is just another way to look at this. This is looking at the top 5 stocks. The solid blue line is the S&P minus those top 5, and then internationally. And you can see, again, how wide that dispersion was as so few names driving the overall market higher. And then, Ken, I believe I've shown this in previous committee meetings, but what this chart is showing is the fall really in interest rates all along the curve, whether it's 3 months out or 30 years or 10 years out. This is where we were a year ago, the gray line, and then the dark blue line is where we are. But you can see how much those yields have dropped just in a 1-year basis. And how that impacts investors is really from a fixed income portfolio. While it provides safety, and that's why we include it in a portfolio, there's not going to be much return there from a yield or interest rate perspective anytime soon. And that's challenging pension plans alike as far as how we're going to meet those return hurdles that we have. We'll talk a little bit more about that later. So now I'm going to move into the performance of the actual plans, and that's starting on page 12. I'll focus on the fiscal year-to-date columns. And so it's showing on the fiscal year-to-date, total portfolio is up 3.2%, and that compares to the composite benchmark of 4.3. The weights, or how we get calculate the composite benchmark, are right below, and I'll get into why there's that lag on a fiscal year-to-date, which really has to do with our alternative investments or private equity. Towards the bottom of page 12, this is showing our current asset allocations versus our policy targets. We look to keep those close. One way we do that is by using any cash flows coming into or out of the plan. And as you maybe were well aware of, we have monthly pension payments. And so when we're raising cash, we're looking at what's overweight in order to raise cash for those pension payments. As that, you'll see a line on there for cash, and may look a little bit high, but at the end of every month, we need to raise cash because those pension payments go out in the first of the month. So this $3.5 million, that's a month-end figure, but we're down just to a few $100,000 because we really try to keep cash at a minimum so it's not a drag on returns. All other asset classes are really close to their policy targets. I just wanted to point out the cash allocation. So I'll continue to pause on each slide. If there's questions, please jump in. I'll let you direct me.
So Brian, we're not looking to change the allocation at all, but I'm just curious your thoughts on looking how we're tracking against the IPS. would you recommend that we consider making any changes, given what you said, the yield curve being so kind of lacking in performance opportunity, but the big run-up in equities? What would you do?
No, because there's been so much action this year and so many changes in the portfolio, and so we've been using those rebalancing the last meeting where we're getting out the last piece of the Wellington Hedge Fund, and so therefore you see we are close to our policy targets. I think in the future we'll talk about if it makes sense to change any of the strategic targets, thinking about that long-term return, but nothing here for this evening or for the rest of the calendar year. Some of those changes that we've discussed in the past, and I think it makes sense to revisit in the next year, is how do we feel about our weights to private equity, private real estate, and I included something based on our last meeting on fixed income of a way to get some additional yield, but it's really a question of is that additional yield worth it right now in the site where we are. That address the question, Carolyn?
It does. Thanks.
Okay. Good. I'll turn to page 13, which starts to get into the asset class or the actual fund performance. So when we're relating to our equities, we own the total stock market index for the U.S. side and the total international stock index from the international. If I look at those on the fiscal year to date, so the Vanguard Total Stock Market Index right on top of its benchmark, so no return dispersion. That's what we want to see from any kind of equity index fund. On the international side, 4.08 versus 4.37. One thing that we've discussed and I've included in this presentation again is why is there a dispersion on an equity index fund? On the international side, there's something referred to as fair value pricing. I'll leave that towards later. It's just a difference between when stocks close on the exchange overseas versus when they close here in the U.S. And that can cause some short-term discrepancy like you see in a few months. But if you look out over long periods of time, say here on the 5-year basis, that dispersion goes away, and it really is just a difference of usually fund expenses. Looking at the fixed income side, we've also taken a similar approach of owning the entire fixed income market on the U.S. side as reflected in the total bond market index, and that's tracked fairly closely to its index. And same with the total international bond index, up 1.5 versus 1.49. What drives differences on the fixed income indexing is usually when the indices price. So for instance, and I've included some of this, is the Bloomberg may price a fixed income security that closes at 3 o'clock, but the mutual funds are valued at 4 p.m. So that's usually what causes performance discrepancy on fixed income indexing. Now, private equity, this is where what's driving the fiscal year-to-date underperformance. Private equity, we report, it's not unique to Fairfield at all, on a quarter lag. We don't have the results for from September 30th yet. So as is indicated in this line here at the bottom of the page, it's a quarter lag. So for private equity, this is the return of the private equity portfolio as of the second quarter, 5.98%, so positive on an absolute basis. But as I talked about at the beginning of the presentation, there was a huge recovery in the second quarter of this year in the equity markets. So the benchmark, which is looking at the Russell 3000, was up over 22% as of the second quarter. So that lag is reflecting some of this fiscal year-to-date performance. But over longer periods of time, the private equity portfolio, which is about a target allocation of 5%, has done really exceptionally well for the pension plan and has been really accretive to returns. So we'll talk about that at future meetings.
Brian, Eric Caliper here. Just a quick question.
Yes, sir.
You can go back to the last slide.
Of course.
Is the Russell 3000 with the plus 3%, is that really the right index that we should be using, or is there a second index we can put in there to kind of have a gauge against?
Yeah, I don't have the history of why that was selected, but really what the Russell 3000 is that is the entire market. You often refer to Russell 2000, that's usually small cap stocks. Russell 1000 is large cap stocks. So that's looking at the total equity market and then putting a return on top of that. If you're locking up your capital for long periods of time, you want to expect to return a premium over the public markets, right? Otherwise, why would you lock up your money for 10 plus years? So that's the little bit of background why I believe, at one point in time, the Russell 3000 plus 3% was selected. There's different indices, I guess we could put in there, Eric, or even maybe some broader indices from providers like a Cambridge comes to mind. Cambridge has their own private equity universe. So I think the Russell 3000 was probably appropriate when it was chosen. I think it still could be appropriate. But if there was something else that you were specifically suggesting, I'd be open to hearing that.
Okay, I'll do some research and maybe we can raise it in a future meeting.
Yes. If there was more global or international stocks there, and I'll relook at the underlying investments to the extent I can, then it would make sense to look at it more of a global benchmark instead of the Russell 3000, which is more U.S. focused or all U.S. focused. But I'll look at other indices that we could put in there for a potential secondary benchmark.
Yeah, that would be good. That's a good idea, Eric. That's always a tricky one to kind of get our arms around, because, and partly because it's on a lag, and then secondarily because we don't have the visibility into the market performance.
Mm-hmm. Mm-hmm. Okay, I'll put that as an action item for myself as well.
Another thing to consider, the private equity is not liquid. It's private companies. The Russell 3000 are publicly traded companies, so you kind of have that efficient market. Everybody knows every day what it's valued at. Private equity, can take time. These are companies that, that you're going to get your return down the road when they might have an exit strategy for their portfolio, where you're going to start seeing much higher returns. So it all depends on where you are in the cycle within the fund. Mm-hmm. So that's another thing to consider, because you're comparing a liquid market with 3% increase for the liquidity.
Right.
Right. It's not reflecting it. When there was a downward market, private companies, they're still doing business. Industrials, were very well capitalized. They had the backstops of their owners, and they had lines of credit. So they continue doing their job, making performance, while the market collapsed, in a short period of time back in March.
Mm-hmm. Yeah, on page 14 is more of, I think, some of the points that Eric is mentioning. These are the fund returns, and these are all different vintages. What I mean by vintages is when a commitment was made to these funds, and some go back to 2013 or maybe even longer. But for instance, Lexington Middle Market 4, this was only funded, I believe, in 2017. So you don't see much of a return history, and also you see a negative return on a one-year basis. But that's typical for a new private equity fund that is making investments and have not received any distributions yet. So you compare Lexington, the 4 fund, to number 2 or number 3, you see a different return profile. And that's why in private equity, you want to continuously be making investments into private equity, because each vintage or each year you're going to get different portfolio companies. And you want to have that diversification. You don't want to put all of your private equity just in one year. And again, we can revisit that as a topic in the future. Maybe to Eric's question, or Eric Kalp, or to Eric Newman. Eric, I think you're on the Stanford board. Do you use a different benchmark for private equity?
I'll get back to you on like the boards I'm on. We're not in the private equity, so other boards, other ones are.
Okay. So with that, I'll just jump to real estate. Also, what I'll call out, this is the Principal Enhanced Property Fund. This is also reported on the lag. So these numbers of 1.7 or 1.27 are as of June. So we're starting to get now the third quarter returns from the Principal Fund, but no surprise to see a negative print for real estate. It's been under stress in this environment. Some sectors more than others, but I've had a call with Principal Real Estate in the last couple of months just to get an update from them, and they've seen the recovery in rent prices and rent collections more specifically, and then they're still having investors that are wanting to get out of the fund. So just to give you an update there, as of 9:30, and I might have said this last meeting, they still have $170 million in redemptions outstanding. The good thing is they still have $101 million in commitments, and we'll just see how they work through that queue. They don't want to be forced sellers, so they're not selling properties in stress in order to raise cash for those investors that want to get out. So they're doing it slowly.
Mm-hmm. Yeah.
Okay. I'm going to move past page 15. This is for the new board members. It just shows the expense ratio of each of the funds. Of course, very low fund expenses, whether it's on the equity side or the fixed income side. And so we're controlling costs here. Page 16 is looking at the OPEB performance. And at a 4.65% return, that is higher than the pension, which was at 3.28%, but that is because, or it reflects a different asset allocation. And the asset allocation is right here on the bottom. The main difference is the OPEB is is a 70% of the assets are in equities, only 30% in fixed income. So by having a 15% more in public equities, there's no private equity in this portfolio, which have done exceptionally well. That's led to the higher absolute returns. So I just wanted to call that out. But also, we're right on top of all of our policy targets, so close to that, and no recommended changes there.
Brian, there's one thing I wanted to point out at this. The total in OPEB is now at least as of October 31, was $55.3 million.
Mm-hmm.
And that's something we used as kind of a loose target. Was once we got to about $50 million in assets, we would think about maybe bringing the allocations closer to in line with where the pension fund is, and not have it. It really is more performance oriented, a little more aggressive in its allocation. I'd ask you to just kind of give some thought to that. I'm certainly happy we didn't do it given how strong equities were in November.
Mm-hmm.
But it's something that I think the board, as a board, will want to discuss.
Yeah, no, that makes sense. And it would be, I'd also, at a later time or offline, understand, how the OPEB is funded. And I think that goes into it. A couple of other public plans and municipalities I work with, they do keep the allocation similar, or if not identical, between the pension plan and the OPEB. And so, we can, for simplicity's sakes, look to do that. That would, I would say, that makes sense to reduce the risk in the OPEB versus the other side on the pension plan. The other difference between the OPEB and the pension, besides the equities, is the higher allocation to real estate. So there's a policy target of the OPEB for 10% of real estate versus 5% in the pension plan. Now, in the pension plan, we've talked about increasing that allocation, but we haven't gotten into it in depth to 10%. So that would be one way to bring it in line. One reason we feel that could make sense is because of we consider real estate within the risk-reducing part of the portfolio, so lumped together with fixed income. And the reason for that is over a long period of time, about half of the return from real estate comes from the income that it generates. And so therefore we feel that that's more of a risk-reducing asset class as opposed to for growth like equities. And then our capital market assumptions are higher for real estate than they are for fixed income right now, given what we talked about earlier about yields being so low. I'll have a little bit more on that in just later in the presentation. So with that said, and the other discrepancy or difference, I should keep using that word, between the two is because we haven't reviewed the OPEB plan in a lot of depth, we still have total stock market index and total international identical to the pension plan, but on the fixed income side, there is an actively managed fund. So we didn't change this earlier in the year. We were focused on the pension plan. That's the PIMCO Global Bond Opportunities Fund. You'll see in the middle of the page, they have outperformed on a fiscal year-to-date basis, and so that has helped the relative return of the OPEB. This was a vastly different story in March. I went back to looking at the returns of March for the PIMCO, and they were behind over 400 basis points. So the return or risk in the market, they benefited from that, and so now they're outperforming. So we could talk about the PIMCO fund if we feel like active makes sense here in the OPEB as well, or if we want to mirror that to what we did in the pension. All right. Any questions before I move into more of the Vanguard approach of how we came to these recommended weights to equities? All right. I'm going to turn to page 21. I've shared this with the committee before in the very beginning of the relationship, but this is just to ground the committee and the new committee members on what are Vanguard's principles when we're thinking about portfolio construction and asset allocation. And those are fourfold. One is the goals. We have this documented through the investment policy statement. Really, what we're looking at is the required rate of return for the pension plan, and that currently stands at 7%. And we really think about that when setting the strategic asset allocation. Balance is the other principle. We looked at that, a very diversified portfolio, even though we have just 4 funds. I'll talk about that more in just a moment. So we have a very diversified portfolio. We're keeping cost low here. I showed you the fees for the 4 Vanguard funds, very low cost basis, and that's so the plan can keep most of the return and not the underlying managers. And then discipline. This is a real important one, as you could see what happened this year. Staying with the long-term targets. We're all emotional. We all react when how the markets were back in March and April. Didn't feel good, but we stayed focused on that long term, and that always leads to to good results. The second part of discipline is rebalancing. And we had that happen with many of our investors this year. And what I mean by that is when markets were falling, equities got underweight to targets. And so when those targets get out of a plus or minus 5% range, we rebalance. So we sold fixed income and we bought equities and to bring that portfolio back to target. And then very recently, this is not in the Fairfield portfolio, but with other investors, because of how well equities have done, we've been recently selling equities and then buying fixed income. So the other part of being disciplined is sticking to your targets, but also rebalancing. One thing that Vanguard does not espouse, and you won't see us talking about in the future, is we're not tactical. We're not trying to time the market. Through various studies that I'd be glad to share, we know that tactical or trying to time the market has led to poor results for many investors. I include this chart. This is a color-coded. It's by asset class. And the only point here is really to see is market leadership can change really quickly. And some high examples is like look at 2016. Small cap stocks were the best performing, but then you go to the very next year, and they're towards the bottom. 2018, one of the worst sectors. Same thing with emerging markets. 2017, it was the best asset class. People try to chase it. Very next year, 2018, it's towards the bottom, down 14%. So I say this in just to ground the committee in that we're not ever looking to tactically trying to time the market. When we make any changes to the asset allocation, those are long-term strategic moves. That brings us into the discussion just around how do we look at or how do we consider building an equity portfolio. And so we include international stocks. Why international stocks? The obvious answer is it builds or brings diversification. So the question is, what's the right amount? This chart is just showing, if you look at the global market cap, now U.S. stocks have done well, but U.S. stocks make up about 60% of the total or the global world equity market cap. International stocks, there's some rounding here, but 42%. If it was last year, international equities were closer to 45. So that's looking at the global world market cap. But then what we looked at, and this is on page 24, sorry if I've caught everyone up, page 24 is we want to consider not just the whole market cap, and when we look at the diversification benefits of adding international stocks. And what this axis is showing is by adding international stocks, what does that do to total portfolio volatility? And we have found through analysis that we regularly update is once you get to about 30-40% international stocks, that's where you get the most portfolio diversification. But as you start to move past 40%, then you start adding more volatility back into the portfolio. And that's how we have arrived at and recommended earlier in the year to a 60-40 split between U.S. stocks and international stocks. And that was really where you were previous as well. So that was not a big change that we made earlier in the year as far as that split between U.S. and international.
Brian, can we back up? I mean, I'm sorry to interrupt. I just want to make sure that this is a reflection of stocks, because the legend is a 60-40 stocks bonds.
Yeah, so this is just the blue line is just looking at an all stock portfolio. The green line, they're running on top of each other. The green line is if you were 60% stocks, 40% bonds, what does it do to the volatility? And so in both of those cases, I mean, it'd be easier if it was just the blue line, for instance.
Yeah, but even just focusing on the blue line, it really shows how you can manage volatility through that diversification of international and domestic. Interesting.
Absolutely. Yeah.
Yeah.
So with that said, as far as how we're looking at the allocation, the next few slides are just to ground you in the actual funds that we hold in the portfolio. So the two equity funds are managed by Vanguard's Equity Index Group, and Vanguard's Equity Index Group manages over $3.8 trillion in equity indexed assets. That has helped us, that scale has helped bring down our average expense ratio across all equity index products to about 10 basis points. So for those that don't know, Vanguard is not a public company. It's not even, doesn't have any private equity holders. CEO or Jack Bogle, the founder, doesn't hold any equity in the fund. You, the investor, own Vanguard through your investments. And so therefore, with that no conflict of interest approach, that when we, or as a company, Vanguard earns profits, because we're still a for-profit company, if we earn profits, we do one of two things. We can invest in the business through enhancing technology or hiring people. And the other way we return profits to you, our investors, is bringing down expense ratios. And so if I had different charts, I would show you how much those expense ratios have fallen. So as assets grow, we return that back to our shareholders through lower costs. That's the Vanguard model, given that we have no public or private shareholders. Now just a quick recap on the two funds. So Vanguard Total Stock Market Index, as it sounds, this is holding large, mid, small caps across all styles, growth and value. So this is 3,500 stocks. We own pretty much the entire market. If you're looking at long-term performance, it's kind of right on top of each other, and then even if you look at a 5-year basis, it's how would the fund beat its benchmark if there's expenses. In this case, you have the institutional plus share class. It's only 2 basis points. And one of the reasons how that happens, I'm going to flip forward a couple of slides. On page 28, this topic we've talked about in the past. Index providers can lend their securities out to, say, hedge funds that want to sell them short. And so we can and do collect revenue from that, from lending those, doing securities lending. We don't do that on the total portfolio. We look at, the way we look at securities lending is only doing it on special stocks or where there's not a lot of, not the biggest large cap names, but more small mid cap names. But more importantly is we return the revenue we get through securities lending. I shared this with the committee earlier in the year. About 95% of the revenue we return back to the fund. A lot of fund companies keep that revenue for their own profits. Because I talked about the profit model with Vanguard, we give all that securities lending back to the fund. So if I get back to the page 26, that's why you can have an index return higher than the benchmark that it's tracking. I'm going to forward to page 29. This is the total international stock index. Also, this is only the whole market, like it says. So this is developed countries like Europe, Japan, but it also does own emerging markets. You see that's about 25% of the international stock index. Also a very low fee, though, of 8 basis points. I've talked about there's some return dispersion that happens in the short term. And as I was talking about that earlier, that can be caused due to fair value pricing. And so that's adjustments that have to be made in the securities by the time, a stock may close on the London Stock Exchange at 11:30 in the morning, but the Vanguard fund doesn't price it until the end of the day, until 4 o'clock. So this stock may close at $55, but maybe if there's bad news that we think that should be reflected in that security, we do reflect that at the market close and at $40. So that's what leads to sometimes pricing discrepancy between the fund and the benchmark, but that washes out over time. So you might have that on a 6-month or even a year-to-date basis, but over longer periods of time, you see that collapse. And I was going to really leave it there. As far as the equity section, Cameron, do you have any questions about that or any other board members?
No, I'd love to know if there are any questions or comments from other board members. I thought that was great.
Okay, I'm going to leave the committee on page 34 then, and this also came to your question earlier in the meeting, Carolyn. This is looking at our return expectations for the current portfolio. This is current policy, looking out 30 years. So using our capital market projections for each of these asset classes. And really when we look out 30 years, the midpoint of our estimate is 6.47%. When we're talking about forecasts, that's obviously shy of 7% that the town has. But anytime we're talking about forecasts, this is just a midpoint. I mean, really, that's to help ground things, but we think of any forecast, as you should, as a distribution. And so we look at that range of distributions between the 25th and 75th percentile. And if this data is used, and this would be used with your actuary, that 7% return target falls within that distribution. And we think that could be reasonable to hit that over time. Though it is pointing out 7% is on the higher end of that estimate, right? And so all public plans are really wrestling with this, of what to do with their required rate of return. The next 4 columns are all topics that we've talked about before. What if we increased real estate from 5% to 10%? What if we increased private equity from 5% of our portfolio up here to 10%? And then this is what if we did both, increase both real estate and private equity. You see those return projections obviously climbing upwards as we're adding more of the alternative investments. At the most extreme case here, if we increase both real estate and private equity, that's still only 20% of your portfolio. And I say only 20 because 80% is in those very, very liquid stock and bond funds. And so we're easily able to raise cash on a monthly basis, even in times of stress. The last column is something new that I included, and this was based on our discussion last month, based on where we are with fixed income and the very low yields. And one thing that we do implement with some total return investors is to increase the weight to credit, investment grade. That's the abbreviation IG, couldn't fit it all in. So if we were to increase our exposure to investment grade credit to be almost 50% of the U.S. fixed income portfolio, and that's reflected in this short-term investment grade, intermediate-term investment grade allocation. But so that's 12% of the fixed income portfolio. So even by reaching for a little bit more yield in corporate bonds versus treasuries, it really is not doing that much to the expected returns over time. We're only talking about 6 basis points. And that's really a reflection of where spreads are in the market. The Fed's been out there. A lot of people are looking for yield. So corporate spreads over treasuries are very tight. And personally, wouldn't say that. I don't know if there's a saying that maybe someone used it last time, is the juice worth the squeeze? But I did want to include that because it is something that we do for portfolios. Is it the right time? That'd be hard to say. Looking at these returns over the 30 years, is it really worth 6 basis points to add that risk? I think there's other ways to do it with either real estate or private equity, though those carry different considerations. So I've droned on a lot. Hopefully I've kept your attention. Hopefully this has been somewhat informative, especially for the new board members. I'll pause to take questions and before I turn it back to the board.
Hey, Brian, Tom McCarthy, I've got one question. Do you have, to what do you attribute a lag or the fact that the non-U.S. equity market is not rebounded? Is there a single thing you can point to and say, yeah, this is it, and this will be right itself? A big thing, Tom, is page 9 when I was talking about it's hard to, well, you can't see or hear at all, but it's what the U.S. stock market holds and what the international stock market holds. And the international stock market is more skewed towards industrials, so more of the value stocks, energies, financials. Those sectors make up a bigger representation of the international markets. And so whereas in the U.S. market, the tech sector is the largest sector, if I just use in this instance the S&P 500. So that's helped lead to the better returns for the U.S. stock market. And this has been going on really the last 10 years, Tom, so it's been painful for investors. I think this is the cause more recently. If you were going back several years, the recovery in the U.S. has been stronger than overseas. And what drives stock markets higher? It's earnings. And so the earnings were stronger earlier in the U.S. in the market cycle. And then more recently, I think a lot of that lag has had to do with what sectors are more predominant in the U.S. market versus the international market. So what would cause it to turn? I think it's two things, Tom. I think one is if you get more of a broad-based economic recovery where you get cyclical stocks performing again. And the other thing is weakness in the U.S. dollar. So the U.S. dollar has been very strong, but has been weakening of late. And if the dollar weakens because of the currency hedging or non-hedging, that would improve non-U.S. stock returns.
Sure.
But I think those two things are when international may start to outperform. But we don't have a good call of when that would be.
Okay. Good. I'll turn it back to you, Carolyn.
I'd like to just give it another moment or two because it takes a while to get unmuted and ask a question, especially if any of our members who are on the phone, if anyone has any questions.
Mm-hmm. While people are thinking or unmuting, I'll just alert you of an email that I'll send to the board is next week that we'll have our economic outlook with our chief economist for the year ahead. We haven't released the paper yet, but once that paper is released and the invite, I'll make sure that all of the board can dial into that call, again, with our global chief economist. And we do this every December, and it's our outlook for the asset classes, inflation, the economy, looking out into 2021.
All right. Brian, thank you very much. Thanks for including all of that information. Maybe next month we can in January we can take a closer look at the fixed income side of the assets.
Absolutely. Glad to speak anytime or take questions in between board meetings. And I'll stay on the call if you need me to.
Okay, thanks. All right, I think if I could ask you, Brian, to stop sharing your screen. We're still.
I'm having trouble doing that, but yeah, I'm trying to unshare.
Excellent. Next up in our agenda is the CFO report. Jared, are you still with us?
I'm still here, and I apologize for not having my video. I've had been having trouble logging on with my password, so you're fortunate that I'm not on video right now. So for new members, as if I'm an old stick at this and been here for years and years, this is my second meeting, I think, maybe my third one. So I haven't been here that long either. So, but for those of you guys who are, it's your first meeting or so, I give an update on the transfers in and out of funds just to give you a sense of and give you some reassurance that we are certainly meeting our obligations to make the payments of our pension funds. And so to that end, we have really four funds. We have two pension funds, one for employees and one for police and fire. And we have two OPEB funds, same thing, one for employees and one for police and fire. As you probably know, the employee side and pension is closed to new employees. And so those payments will hopefully get in the amount needed to fund that fund will continue to go down over the years. So I'll get right into it and just go into some of the numbers of what's happened over the past month. That's the basis of my report. And so back in, because of the timing of things, we hit a period at the end of October and October 27th when we had money going out of it. So there's also a fund that we call the fund. It's just called the funds, which kind of serves as the mechanism for getting money into each of the individual pension funds. And Brian kind of alluded to this in his presentation. We don't keep a lot of money in the pension funds themselves, except when we need to make payments out of them. And so those you'll see on October 27th there was a transfer into the the town employees fund of $1,229,000 and into the fire and police fund of $1,211,000. And on November 23rd, there was a transfer to the employees fund of $873,000 and to the fire and police of $886,000. And so that money was to cover expected payments, which I believe went out yesterday to the retirees in the amount of $1,134,000 for town employees and $1,121,000 for fire and police. And that is my report. So we did indeed were able to. So there's always kind of a little moving around of money as we get closer to the date where payments have to where those pension payments have to be made. And so that's what these transfers are for, to make sure that we can cover those payments. Any questions?
Eric?
Yeah, just since we've moved from Callan to Vanguard and we've had a change in CFO, previously in the Callan reports, we would see cash flows in and out of funds. We don't get that transparency in the Vanguard report. And Mr. Mayor used to present a cash flow report to the board so that we knew on a monthly basis where the money was being transferred in and out of the funds. I think we should. The report was awesome, but I'd love to have something at least presented in format that we could look at and have moving forward.
We can do that. I can put this into a document with the help of Peoples and Vanguard to get this into a document before the meeting, so you can see what's happened. There are some other, I'll say, smaller transfers that occur as well from investments that take place and other investment wires that happen throughout the month. So we can definitely do that in the future.
And that would be awesome. Thank you very much.
Mm-hmm.
Sure.
Yeah, to that point, we're getting distributions from some of the private equity funds, and we're also getting capital calls from the private equity funds. And so those are all funds that we're working together with Jared and Caitlin still to raise or to invest.
I got a question. When our funding policy, right? Do we fund it quarterly, like the employer contribution? Every year, part of the budget process, there's an allocation goes to the new members. Part of the money goes into the pension fund and the OPEB. Is it funded quarterly, monthly, annually?
Brian, do you want to answer that?
Yeah, I don't have enough insight into that, Eric. I do know from this year, because I'm new with working with the town on this. I believe the contribution was made for the pension plan all at once back in the September timeframe. We had, I'm not going to quote me, but or $5 billion kind of come in. And so at least this year, I haven't seen those quarterly payments in. I just saw that one big payment.
I know this is an unusual year because, plans are delaying contributions. So on a normal cycle of previously, was it? I know it goes to everybody's news. So just curious.
Yeah, I don't unfortunately have the history of what was done in previous years.
I will put that on my list, and we'll get that to you as well.
I want to say it was front loaded. I think that the money went in early in the fiscal year, and I think there was some kind of benefit from that there was a reduced contribution because of that, because they assumed that you made money on that initial contribution up front. If I remember correctly from previous Board of Finance meetings.
This year's a different type of situation. You don't want many communities didn't want to fund up front just because they know what was going on in the future.
Confirmation.
Yeah, I mean, guys, I think it makes a lot of sense, particularly since we've now lost our real continuity here with Brian Vahey and Ken Brockfeld terming out. This is new for a lot of us, and it might make sense to spend a little bit of time and come up with help us understand how the funds flow, how the cash works, so that we as a board can gain a little better sense of how it works and feel more comfortable with the level of transparency that allows us to make our decisions.
Sure. Yep. We can do that.
Any other questions or thoughts? All right, we'll move along. Guys, thank you, Jared. The next stop here on our agenda is old business, the update on the RFP. So as you, I think, are all aware, we made the decision earlier this year to go out to the market in search of with an RFP in search of actuarial services. It's something that actually we haven't done as a board, I think, for a really, really long time. So it's a great process, and it's a great experience to go through. It allows us to update to kind of some best practices, including putting end dates on our contracts and making sure that we are asking for and receiving kind of best-in-class services. The RFP has been drafted. It went through the purchasing department of the town. Our town CFO, Jared, has looked through it, approved it. He sent it to me. I've sent it to Eric Newman. We've taken a look at it, and we're kind of in that final phase. If anyone else would like to see it, it's a pretty dense document, so I'm not going to ask to be sent around, but if you'd love to see it, I'm more than happy to share it to any member of this board. Our target date to put it out is early January, with kind of a target in mind that we would have responses in. We'd be able to take our time as a board to bring in, a couple of the candidates who responded, have them come in to present to us as a board their services. We're then the ones who make kind of the decision as far as who to hire, and with an idea that they would start up with us just at the beginning of the new fiscal year, right? So we don't get in the way of the budget cycle. We kind of close one out, begin one in a very natural sense of timing. So if you after this call, or if you'd like to see a copy of it, we'll send it around. You can email me or let me know now. Otherwise, we'll be back to you in January. Eric, do you have any thoughts? You went through it with a fine-tooth comb. Eric Newman?
Yeah, it was very good, well done. There's other things I probably want just in the future, we want to look at, one thing I've been seeing in best practices is getting breakdowns of diversity within organizations. It's thinking of that ESG, really good governance, having diversified organizations, and so in the future, just we might want to keep that on our radar. Even looking at investment, looking at what's the breakdown of leadership? Are they moving the right direction, or are they staying in and something in the past. So, I'm a big believer that we need to move forward, have diversified investments as well as board leaderships within the portfolio. So this would be the same thing.
So typically we get a presentation in February and March for the contribution for fiscal year. Who would be presenting at that meeting?
Same, Hooker and Holcomb.
Okay.
It's the same one, right? It was just too much to ask for to rush with so much change to make that switch mid fiscal year stream. So yes, we'll continue with Hooker and Holcomb, and we'll parallel track with the RFP.
Is there for the RFP committee? Is it the entire board? Is it a segment of the board, or how does it work in the town here?
Well, it's us, Eric. It's Eric Newman and myself. Nobody else raised their hand, surprisingly, to get into the RFP of an actuary process. But again, if anyone would like to, there's still a little bit of time to jump on board.
I'll wait for the Reader's Digest version to come out.
Fair enough. You will all be involved when we evaluate the respondents, though. So buckle your seatbelts, guys. So, then with that, that's all we have. I don't know if anyone else has any final comments before we seek a motion to adjourn.
The only thing I would recommend is maybe in the next couple of months, I know we have a bunch of new board members. We may want to circle around on the Allianz and just kind of bring the members up to speed. I know it's been a couple of months and there's been some developments in the news. Maybe we can get some clarity on where that is.
Yeah, absolutely. I think maybe a briefing with the town attorney and the attorneys on that to bring everybody up to speed on that. This board had an investment into a fund with a fund company, Allianz, and early into the COVID shock, that fund really performed uncharacteristically poorly. Really uncharacteristically poorly. And we moved very swiftly as a board to redeem our investment in that fund. But we also initiated an investigation, a legal investigation into what may have been, something that was out of character, right? And I'm not at liberty to say, guys. I wasn't involved in that was Brian and Ken who were called in with the town attorney, and so I've got to catch up with that. But I think we're probably due a status update. So I'll add that. I'll add that to the January list there.
That probably should be an executive session. So
Yeah.
It's something to consider when we do the agenda.
Yeah, I'll make sure to circle back with the town and with the town attorney as proper way to handle it.
A good point.
Yeah. All right. Anything else? All right, everyone. Thank you for joining us tonight. We have a motion.
I'll make a motion. We adjourn.
All right.
Caliper.
Second.
All right.
Hey, congratulations, Carol.
Thank you very much. And to you, Tom. I look forward to it, guys. Thank you.
Bye.
Congratulations. Thanks, guys.
Thanks.
Merry
Bye.
Christmas.
Bye-bye.
Bye.
All right, have a good one, guys. Bye. Bye.
Thanks, everyone. Bye.